So today we'll discuss few things, cash flow analysis for the taxation. Cash. In the year 19, closing balance was 15,000, but 20 closing balance is 9,000. So this 15,000, 9,000 issue is here. So it is the cash flow. And if we see another one, direct method. Previously we have seen the indirect method, now the direct method. The following are the balance sheet a trade company 31st December 20 and 19. The exact from the profit and loss account for the end December, and that require or prepare a statement of cash flow under the direct method. So here 19 and 20, cash, receivable, doubtful debt, inventories, furniture, accumulated depreciation minus here, and payable, debenture, and total item is here, and share capital, return earnings. So here total asset 1,06,800 and total liability and owner's equity 1,06,800. So another few information: net profit and loss account, net sale 95,000, cost of goods sold 44,000. So here gross profit 51,000. Operating expense including depreciation is 28,600. Net profit 22,400. Dividend declared and paid 20,000. And given the additional information, during the year, furniture costing 10,000, on which 8,000 depreciation was provided, and sold 1,500. The loss of disposal of include the selling and administrative expenses, but it should not be in the selling and administrative expenses. It directly go for the financing activities. So here is the cash flow statement in direct method. So what is the difference, direct and indirect? And direct method and indirect method. Indirect method start from the balance of profit and loss account, and direct method start from the cash received from customer. So we have to calculate it in a working here. Cash notes here, two notes is here. One is accounts receivable. Look here, balance. That means cash, that is, we can say the cash balancing figure here come, balance BD come from the previous balance 12,700 is come from the balance sheet. Here receivable 12,700, this one receivable 12,700 in the year 2019, and 28,300. So these two balance within our dash ledger. So look here, this balance, beginning balance is 12,700, closing balance is, that means in the year 18, 8,300. So here net sale as said in the information 95,000. So putting this net sale here, so total sale is 1,07,700 and minus say from that 8,300, then we will get cash balance received, that received from the our debtors 99,400. This 99,000 is the balancing figure, 99,400. If we put here this one 99,400 is text file from the note 1, and cash paid to supplier and employees here taking also note 2. Here balance is 20,800. Take the material from the supplier. We that's our creditors, so we have to pay them. So in the year 19, the balance was 20,800. 20 is balance 16,000. So these two figure, if we put here, look here, balance BD is the payable. This is the receivable. So debit balance and payable is credit balance. So this is the opening balance 20,800 is for the year closing of 19, and this is the balance for the closing balance 16,000. So how would put purchase 40,000? How come purchase? This, look here, this one cost of goods here 44,000. Operating expenses 11,900. 11,900 cash operating expense. Here purchase amount 40,000 and Cash operating expense 11,900. So here total 72,700. And if we adjust with the balance, closing balance 16,000, then we will get a balancing figure of accounts payable, that is we paid 56,700. This 56,700 minus from the cash received. So this is the receipt and payment. So net cash flow from operating activity comes 42,700. This 42,700 is count from the operating activities through the directly received from the customer and payment to our supplier employee for the operating purpose. So this number one. And if we see the number two, cash flow from investing activity, purchase of fixed asset. So fixed asset, how much fixed asset here? Look here accumulate depreciation, furniture, all is putting here. So here purchase of fixed asset 30,000 as per from the data. So 30,000, and sale of furniture, this 1,500. This 1,500, it is also the investing activity, because furniture, the fixed asset, is the investing activity. So this positive and negative equivalent, the cash used in the investing activity is would be the negative one, 28,500. And the cash flow from the financing activity, dividend paid 20,000, redemption of debenture 20,000, and proceed from issue of share. So total 16,000. So total would be 18,000, because 42,700 positive, and this 28,500 it would be negative, and this also negative 16,000. Total decrease and ether and so on. So cash and equivalent beginning of the year 9,700, closing would be 7,900. What is that? Look here, 9,700 is the 19, and the 27,900 is the closing balance of 20. So this way, here are some few correction. I will correct it and mail you. So this is the direct method from the cash flow only operating side, receipt from the customer and payment to the supplier employees, that include in your operating activity. So this way, direct method we can calculate. And here is working capital management, some review of previous chapter. So here calculation here, I think you would be able to do it, because all calculation is here. And another one, corporate restructuring, sometimes for just understanding. And one thing for the how corporate restructuring means, here we know the merger acquisition, one company take another company for the acquiring another company, all one or two company they can merge, each other. So company X wish to take over company Y. The financial details of two companies are equity share at the rate of 10 taka per share, here 1 lakh, here 50,000. Share premium, this is no premium, but it's 2,000. Profit and loss account, balance 38,000, it was 4,000. Preference share 20,000, there is no preference share for the company Y. And 10% debenture 15,000, it has 5,000. Total 1,70,000. It should be a line here. So here 61,000 total. Then fixed asset 1,22,000, here 35,000. Net current asset 51,000, 26,000. Maintainable annual profit after tax for the equity shareholder 24,000, 15,000. Market price per share 24 and 27. Price earning ratio 10 and 9. So you offer do the thing that X could make company Y in terms of exchange ratio based on the net asset value, based on the earnings per share, based on the market per share. Here three methods. Which method should be that is profitable for the company X for taken over Y? First one, net asset value base. So if we go net asset value, exchange ratio based on the net asset value. Look here. Here putting the two companies. Fixed asset 1,22,000 is the, look here, 1,22,000 for the company X, and Y 35,000. This 35,000. And net current asset here 51,000, here 26,000. So adding these current asset, total asset comes for the company X 1,73,000 and Y 61,000. Here let's from that asset preference share and 10% dividend, because this is the obligation have to pay. So from the net asset, if minus the preference share debenture from the both company, because there is no preference share for the company Y, but debenture both company. So if we minus, the net asset come after fulfilling the obligation, net asset come 1,38,000. Here come 56,000. So number of share it have, because 10 taka per share. So if we divide 1 lakh divided by 10, then we will get 10,000. This 10,000. And if we 50,000 divided by 10, then we will get 5,000. So this is the number of share. If we divide 1,38,000 by the number of share, then we will get net asset per share. So 13 taka 80 paisa, it is the net asset per share for the company X. And same way, if we divide 56,000 divided by 5,000, we'll get 11 taka 20 paisa. It is the per share value as per the, that is net asset per share of the company Y. So based on this net asset per share, we should calculate the exchange ratio. So look here, company X 11 taka 20 paisa, this 11 taka 20 paisa, if we divide 13 taka 80 paisa, so exchange ratio would be 0.8116. It's mean that the shareholder of company Y should get 0.8116 number of share of X for every share held by them. So it's the exchange ratio. So based on that ratio, company Y issue total share and give to the company Y company shareholder and acquire total company. So this is the exchange ratio based on the net asset value, total asset value. Now another one, EPS. Earning per share after equity, that is equity holder, here 24,000, here 15,000. So look here, this 24,000 and 15,000, if we divide number of share that we have calculated here 10,000 and 5,000. So if we divide 24,000 by the 10,000, then we'll get EPS 2.4. That means EPS of company, earning per share of company X is 2.4, and earning per share of company Y is taka 3. So how would be the exchange ratio? So look here, exchange ratio taka 3 divided by taka 2.4, then we'll get 1.25. So the shareholder of company Y should get 1.25 share of company X for every share held by them. So look here, if the company X acquire company Y, then each and every shareholder of Y get 1.25 of share of company X. So this is the exchange ratio. Another one, exchange ratio based on market price per share. So here said that market price per share 24 and 27. So here, look here, 27 of company Y's market price divided by market price of X, 24, so get 1.125. So in this case, we can say that the shareholder of company Y should get 1.125 share of company X for every share held by them as per the market price per share. So here we have seen three calculation of exchange ratio between one company to one company. If one company wants to acquire another company, how they exchange, how they purchase, what would be the purchase price of that company. So look here, how total purchase amount you can calculate. Number one, 0.8116, if we multiply by the number of share 5,000, the total value would be that of the company Y. So this one. Another very simple, as like previous one, a company wants to acquire T Limited, another company exchange 0.5 of the share. For each share, the relevant financial data, earning after tax, company A Limited 18 lakh, company A Limited 18 lakh, company T Limited 3,60,000. Equity share outstanding here 6 lakh, here 1,80,000. Earning per share taka 3, here 2. Price earning ratio 10 times, here 7 times. Market price per share 30 taka A Limited, 14 taka T Limited. So here 5 calculation. What is the number of equity share required to be issued by A Limited for the acquisition of T Limited? So look, it's very simple. Number of share T Limited 1,80,000, but condition is that they should exchange 0.5 number of share A Limited. So 0.5. So get 90,000. So 90,000 share should issue by the company A for acquiring company T. Number 2, what is the EPS of A Limited after the acquisition? After acquisition, all revenue go for the company A. So look here, EPS, before acquisition, profit was 18,000. After acquisition, that 3,60,000 profit of company T, and also the owner of the A companies. So here we have to add it and divide the total number of share. Previously, number of shares 6 lakh and newly issued 90,000. So 6,90,000, if we divide, earning per share 3.13. Here look, their earning per share was previously before acquisition, it was taka 3, but after acquisition it increased 3.13. So it's the positive thing. And if we see the C, determine the equivalent earnings per share of T Limited. Per share of T Limited is previously earning per share was taka 2, but now its earning per share comes 1.565. How it's come? Equivalent EPS, that means EPS of combined, that means after acquisition 3.13, and this one share, it is the one EPS of per share, earning per share 3 taka 13%. So it's half, owner is company T, so multiply half, so it's come 1.560. It's less than the previous one. After acquisition, the EPS below of the before acquisition of T company, but A increase. And what is the exchange market price share? P ratio multi branches. So expect market price. What would be? 3 taka 13% multiply 10 times. This 10 times includes, that means price earning ratio 10 times of A Limited. If it's fixed as per the question, then the value, market value per share is 30 taka 30%. And determine the market value of the merger firm. Total value of the firm would be market value per share 30 taka 30% multiply by 6,90,000 share is come 2,15,97,000 is the total market value of the company. Another math we have seen, the capital budgeting, is the just reviewing it for previous. Here taking the 2 PB factor 13, 15. So answer is here. Just you try it, and if you do not possible, then we will discuss, because we also take your next time tax audit part of 303C. That one I will take also from the next class, tax audit part. So from that we can discuss later on also. So here ratio analysis one math. So here the calculation is here. Working capital another math. So here calculation is here, and it comes from your previous question. For example, your batch 2, that was the 15 marks, and also I think you know it, previously we discussed this, as answer is here. And another batch 1, question number 3, 15 marks, it was that leverage effect, calculation is here. And batch 1, question 4, March 15, it was your working capital calculation, answer is here. And also batch 1, question number 5, ratio analysis, solution is here. Discuss difference way. Also in the batch 1, it was the question, and solution also here. That all soft copy with in my Google Drive also, you can download it from here. Also I will upload this newly, I will be upload. So here batch 2, that was the question and is the solution. Batch 3, it was the question and it was the solution. And batch 4, it was the question, it is the solution. Batch 5, this is the question and solution is here. And also is the model question. We can discuss with this one, is the model question. Also this one is putting also question side. This is the model question and solution is also here. So I think that type also, you know, there we have within the pandemic, our exam would be few objective type and few that means 50%, more or less 50% question would come from the objective type. So I think we'll take another class for this initial statement analysis. We'll take another class.